that looks good for now, and let's actually begin trading hour by focusing on the market at large, and we're going to get a conversation going. We have Prateek Parekh joining us. He's equity strategist at Nuvama Group to take some questions on the market now. Prateek, it's always a pleasure to have you on the show. Thank you for joining us. And I want to begin by a point that you've mentioned in your report as well, which you're saying that you're cautious because of the high valuations amid slowing top line growth and elevated rates. Tell us, after this Q1 earnings season has been done with, how have you really read it, and what is your estimate in terms of the kind of EPS growth that we can see for this financial year, for FY24?
Yeah, thanks, Pavitra, for having me over. It's always been a pleasure over here. I think if you look at this quarter's earnings season, right, it's been a mixed bag. I mean, from our 2 or 3 key takeaways from this quarter is that we are starting to see top line moderating. Across sectors, there is a sense of top line growth slowing down. Some of it has got to do with the fact that input prices have cooled off, so your output prices are cooling off. But nonetheless, that is a trend that we need to monitor. Where we do see clearly demand being weak very significantly is, I think, on the external front, where whether be it IT, be it chemicals, you are seeing very sharp slowdown. Second space is the mass market consumption, which is like FMCG, like actual volume growth, or if you look at some of the consumer durables, which are more consumer facing, there are demand challenges. Where demand is still holding up, I think, is in the high end consumption, and also which is like real estate and the high ticket like SUV sales, and in the industrial space, perhaps going to government capex. Now, our main worry is that going ahead, these spaces also could eventually see some pain points. Government capex, we have seen front loading and that can continue, but nonetheless, given that tax collection are slowing down, some moderation should be expected in the same. With regards to high-end consumption, which has been a very strong theme for some time now, in this quarter, I think it's got to do with the fact that the formal sector wage bill growth is still holding up very well. In this quarter as well, the BSE 500 wage bill growth grew by 18%. And yet, despite that, companies were able to expand margins. The simple reason is that the input prices fell owing to supply concerns. Now, going ahead, where we do see challenges is that the benefits from supply side are behind us. And if demand remains weak, corporates will have to either sacrifice margins or claw back on the wage bill part. We think the latter is more likely. And to that extent, even in urban consumption or the high-end consumption, which has been holding up, could see some moderation. So to that extent, we do think that top line will moderate. Margins, although, should remain better off, especially in some of the sectors where input price is a big factor. We expect margins to hold up over there. And overall, earnings momentum to moderate from here on. With regards to EPS growth, we have around 16-17% forecast for the next 2 years. Which was just 10% in FY23, which we think is somewhat on the higher side per se, Pavitra. And given the context of slowing earnings growth, but still, cost of capital being elevated, we are somewhat cautious on the markets, I would say.
Prateek, I just want to talk about the top line slowdown, which is one of your foremost worries. The BSE 500 companies, which have reported numbers in Q1, the top line growth has slowed to just 6% on a year-on-year basis, and 30% of these 500 companies have reported a contraction, a revenue decline on a year-on-year basis. And you're saying this broadening of the moderation in top line, 30% number, is similar to what we've seen in the past crisis. Could you elaborate a little bit more on that? And do you expect this top line moderation to continue? Can the number get even weaker than 6%, or does it broaden to say a 40%, in terms 40% of the companies reporting a contraction?
Yeah. Again, a good question, Rima. So I think on top line front, the main reason why it has weakened is because of the global deflation that we are going through. I mean, global commodity prices are down very significantly. Some of it is going to easing of supply concerns, but there are demand issues as well. I mean, even on the macro front, if you look at it, our exports are contracting by 15% YOY, which is a very large contraction, and clearly suggests or reflects the weak external demand outlook per se. So that is definitely a factor which is feeding over here. But apart from that, I think the income dynamics is what is more worrying to us per se, Rima. And that is something that we monitor going ahead. Going ahead, if domestic income dynamics also remains weak, then the moderation you see in top line will not just be led by prices, which is the case right now, but actually will show up in volumes as well. volume numbers across industries, can see a moderation going ahead. What can change this in our view? I think two or three things. One is on the external front. If we do get some better recovery, then clearly the top line moderation case is much weaker going ahead. But if not, then I think the slowdown will likely broaden. Top line growth will most likely remain in single digits, and I think the breadth of top line will actually worsen because while commodity top line will stabilize from year on a year on year basis as the base effect kicks in, but the other sectors may actually see some slowdown, cooling off of sorts per se. Apart from external front, I think on the domestic front, if we do have RBI being a bit more easy on liquidity and allowing interest rates to be a little bit lower, I think that can help in preventing the top line contraction. But if not, then I think you will see some more broadening going ahead for Sarusai.
Okay, Prateek, do sound fairly cautious, might I say borderline bearish, but that's fine. We need to understand and take that view on board. I'm quickly coming down to your portfolio strategy now, where the underweight sectors are actually BFSI, industrials, commodities, one understands, I mean, it's all global facing, real estate, and you're actually overweight on FMCG, technology, telecom and pharma. So in some sense, this is like an anti-consensus stand, isn't it? Because you have most participants in the market still very, very bullish on banks, despite this margin compression concern. You're going underweight on industrials, and that sort of has been the biggest, so to speak, a thumping point for the market. Just give us a ballpark bird's eye view on these calls, and why are you preferring defensives now, including something like IT?
Yeah. Again, Suki, thanks for asking. So I think on industrials, we've been underweight since start of the year, and honestly, the call hasn't really worked well. In fact, it has been the sore point of our portfolio and has brought down our relative performance of sorts per se. Now, our call on industrials and financial overweight in general is that if you have exports being weak, domestic consumption, the large part of it slowing down, it is very difficult to believe that capex will continue. I mean, government is right now pushing capex, but even there, with tax revenue slowing down from here on, the momentum on that front also will slow down. And that's why we are very underweight industrials. I mean, if you look at our report, we have data where we show that India's industrial companies order book also moves very closely with global growth cycle. Post-COVID, there has been a delay because in India we had wave 2 and so on and so forth. As a result, the pickup in industrial cycle has been delayed. But historically, they tend to go very much together. And given our valuations are, the margin of safety is almost nil. Even a small moderation in margins or on top line can lead to big derating in some of these stocks. And that's why we are underweight industrials. On banks, our call has been that banks right now are in a purple patch in FY23, where you had margins firing, credit growth being accelerating, and credit growth being benign. Out of those three, we are already seeing margins, cool off. Incrementally from here on, we think credit growth also should start to cool off as the incomes on the higher end starts to moderate. And as a result, financials, which are very deep cyclicals in the sense some moderation top line, the flow through the bottom line is actually quite significant, can see a lot more earnings downside, maybe in FY25 numbers and FY26 numbers per se. And that's why on banks as well, we are cautious and we are very much leaning towards the top tier or the large banks of sorts per se. With regards to our defensive stance, I mean, it clearly emanates from the fact that we believe that the top line is going to slow down. And if that is true, you're better off buying sectors where margins will hold up and your profitability will hold up. And second, also, in these sectors, these are all cash-rich companies. Valuations are somewhat more reasonable now on a relative basis. And that's why, we're over these sectors. And I'll just make one point on IT, that IT, despite all the global slowdown, I just want to highlight that IT has actually outperformed Nifty during all the past global crises. And the simple reason is that IT, because of it benefits from minor depreciation, which typically comes to the fore during global crisis, and also it's a cash-rich sector, and the sector generally underperforms much ahead of the crisis. And going ahead, we think that if global growth slowdown is going to further worsen, then I think IT may not necessarily be a bad place, to have in a portfolio per se. So,
Got that, Prateek. Interesting point, as I said, anti-consensus, and that's why the view really stands out. We look forward to more conversations, and pretty sort of interesting way to look at IT as well. Pretty much like a store of cash in times of volatility or maybe negativity. Thank you for joining in, and appreciate you being with us on the show today. Well, with that, let's move on to the next story. And